Welcome to the Deep Dive. Today we're digging into Conagra Brands, specifically their Q1 Fiscal Year 2026 report.
And the big news right off the bat.
Adjusted earnings per share came in at $0.39. That really smashed the analyst forecast of $0.33.
Yep, and the stock jumped about 2.4% pre-market on that news.
So our mission today, unpack how they managed this beat despite inflation, and look at why they're sticking to their full-year guidance.
Okay, so let's start with those results. It's important, like you said, to focus on adjusted numbers, but let's maybe quickly touch on the reported ones first.
Good idea. So reported net sales were $2.63 billion, just a bit over what people expected.
Right, but the reported diluted EPS, well, that actually fell sharply, like almost 65% year over year.
Wow, okay. That sounds pretty bad. So explain why the adjusted number is the one getting the attention.
Well, the adjusted figure strips out things that aren't part of the core ongoing business, like gains or losses from selling off brands, restructuring costs, things like that.
Got it. So the $1.39 adjusted EPS, even though it was down from last year's 73 cents adjusted.
Exactly. It was down about 26%, but crucially, it beat the $33 forecast by over 18%. That's the signal that the market liked. It shows better operational performance than feared.
And that beat seems to have given them confidence. They immediately reaffirmed their full fiscal year 2026 guidance.
That's probably the biggest takeaway here, honestly. Management is basically saying, yeah, Q1 was better than expected and we're still on track for the year.
So what are those reaffirmed targets again?
They're holding organic net sales growth between -1% and +1%. Adjusted operating margin is still targeted between roughly 11.0% and 11.5%.
Adjusted EPS.
Still expected between $1.70 and $1.85 for the full year. No change.
Right. And the CEO, Sean Connolly, talked about solid progress, right? Mentioned hitting supply chain goals, getting service levels back up.
Yeah, fully restored service levels was a key phrase.
Yep.
And advancing the portfolio reshaping, which means those divestitures we knew were happening.
He's essentially signaling the internal house is in order.
Which they really need it to be to fight those external cost pressures we keep hearing about.
Okay, let's dive a bit deeper into the sales figures, because total net sales were down 5.8% to $2.6 billion. That looks like a miss if you don't dig in.
Exactly. That headline number includes the impact of selling off brands. Those divestitures accounted for 5.1% of that decline.
So the underlying business, the organic net sales.
That only decreased 0.6%, much smaller dip, almost flat, really.
Okay, 0.6% down organically. That's actually pretty resilient. But volume was still down 1.2%. So how did they make up that difference?
Pricing and mix, that provided a 0.6% positive lift, perfectly offsetting the volume drop in the organic calculation.
So they took price, maybe sold a better mix of products.
And also had some favorable timing on what they call trade expenses, basically, when promotional costs hit the books. It shows they are getting higher prices, but, it's costing them a bit of volume.
Which brings us to the margins. That seems to be the real battleground. Margins contracted quite a bit.
They really did. Adjusted operating margin fell 244 basis points. That's quite a drop, down to 11.8%.
And gross margin.
Adjusted gross margin was down 153 basis points to 24.4%. And here's the key thing. They actually had strong productivity gains. Over 5% of CAG.
5% internal savings is huge. That's impressive efficiency.
It is, but it wasn't enough. Those gains were completely wiped out by the lower net sales overall, the impact of cost of goods, sold inflation hitting them hard, and lost profit from the businesses they sold.
So running faster just to kind of stay in place margin-wise.
Pretty much sums it up. The external cost pressures are just that intense right now.
Anything else on the financial side? Capital allocation?
Well, one positive note. Interest expense was down over 11% to $94 million. That's directly because they've been paying down debt.
Using proceeds from those divestitures.
Exactly. And they also bought back about $15 million in shares, mostly just to offset dilution from stock compensation. Pretty standard stuff.
Okay, let's shift to the strategic execution side. Because beyond the EPS beat, the story seems to be about fixing the operations and reshaping the company.
Definitely. The portfolio shaping was a big success this quarter. Selling off Chef Boyardee, Van de Kamp's, some frozen seafood that generated cash.
How much debt did they pay down?
Over $400 million reduction in net debt just in Q1. That's significant.
And what did that do to their leverage ratio?
Brought the net leverage ratio down to 3.55 times. They're making real progress towards that long-term target of 3.0x.
Which gives them more flexibility, especially with margins under pressure.
Exactly. And then there's the supply chain piece. The CEO highlighted it. Service levels hitting 98%.
What does 98% service level actually mean for the business?
It means when retailers order products, Conagra can actually deliver them 98% of the time. It means products are on the shelf. That reliability is crucial.
And did that translate to market share?
It seems so. They said 44% of their portfolio either held or gained volume share in the quarter. That's likely a direct result of being able to supply consistently again, compared to maybe a year ago when they had more constraints.
So fixing the operational basics pays off.
Absolutely. It's foundational.
Okay, let's break it down by segment. Refrigerated and frozen. R&F, that's a key focus area. How did they do there?
It's interesting. Organic net sales actually increased 0.2%, and that was driven by volume being up 0.5%.
Volume up in this environment.
Yeah, partly because they were comparing against a period last year where they had really bad supply problems, especially on things like Hebrew National hot dogs. So some of it is just recovery.
But you said interesting. What's the catch?
The catch was the margin. Adjusted operating margin in R&F fell. Wait for it. 402 basis points.
Ouch. 4 full percentage points. Why such a big drop?
Mainly two things. Really high inflation on proteins, beef, pork especially, and what they call transitory modernization headwinds. Basically, costs related to upgrading their supply chain. So yes, volume recovered, but it was very expensive volume to get.
Okay, what about the other big segment, grocery and snacks? G&S.
That was more of a mixed picture. Organic net sales there were down 1.0%, and volume was down 1.6%.
So still seeing some volume pressure there. Any bright spots?
Yeah, their strategic focus areas within snacks did okay. Meat snacks volume was up 4%, seeds volume up 2%. People seem to still want those protein snacks.
But overall, volume was down. Where was the weakness?
Well, you saw clear examples of price elasticity. Duncan Hines baking mix volume dropped 8%. That was after they had to raise prices because of cocoa costs.
So consumers pushed back on that price hike.
Looks like it. And Angie's Boom Cedar popcorn volume was down a surprising 19%. Though management said a lot of that was just promotional timing, shifting spending from Q1 into Q2.
Still, it shows how tricky managing pricing is across all these different categories.
Definitely a balancing act.
All right, let's look ahead now. Q1 showed good internal control, but the rest of the year depends a lot on the external stuff, especially inflation. What's the latest update there?
It's ticking up slightly, unfortunately. They previously talked about core inflation around 4%, but now they expect total cost of goods sold inflation for the year to be in the low 7% range.
Higher than the roughly 7% they thought before.
Yeah, just nudged up a bit. The main drivers are still animal proteins, beef, pork, turkey. Costs are climbing.
And are tariffs still a factor?
Oh, absolutely. They're still dealing with those high tariffs, 50% on imported tin plate steel and aluminum, 30% on some Chinese imports. They estimate that adds about 3% to their annual CAG, even after they try to mitigate it.
Okay, so costs are creeping higher. That leads to the big question. How can they reaffirm guidance? And you mentioned something about Q2 specifically.
Right. This is the really important caveat for the near term. They explicitly warned that Q2 operating margin is expected to be moderately below the full-year guidance range of 11.0% to 11.5%.
Below the range. Why the sudden dip in Q2 after a strong Q1?
It's all about timing. Think of it like this. In Q1, they benefited from using up older inventory that they bought before some of the tariffs hit hard. That inventory shield is gone now.
So Q2 feels the full brunt of the tariff costs.
Exactly. That favorable impact reverses. Plus, remember that favorable trade timing in Q1? Some promotions got pushed out.
Yeah, on things like the popcorn?
Right. Well, those costs are expected to hit in Q2 now. So you've got higher net tariff costs and higher promotional spending hitting Q2 margins. Q1's gain is kind of Q2's pain, in a way.
Okay, that makes sense. So Q2 looks tougher, but they still expect to hit the full year numbers overall.
That's the plan. They must expect things to improve or stabilize in the second half of the fiscal year.
Did they tweak any other full year financial assumptions?
Just a couple minor things. Because they paid down debt faster, they now expect low interest expense for the year, $390 million instead of $400 million.
Okay, that's a positive.
But on the other hand, their tax rate was a bit higher in Q1 than planned, so they bumped up the expected adjusted effective tax rate for the year slightly from 23% to 24%. Minor adjustments, really.
All right, so let's try to sum this up for you, the listener. Conagra seems to be executing quite well where they have control. They've cleaned up the supply chain, they're finding cost savings, and they use those divestitures effectively to pay down debt.
Right. And that focus on frozen and snacks is showing some signs of life, especially in recovering volume and holding share where they can reliably supply product.
But the big challenge remains those external costs. Inflation, especially protein costs, and tariffs are putting constant pressure on margins.
Exactly. It's a story of strong operational execution battling significant headwinds. Their internal productivity gains are impressive, but they're basically just offsetting inflation right now, not really expanding margins.
So here's a final thought to leave you with. Conagra is really committed to that long $1.40 annual dividend. They also have that long-term goal of getting net leverage down to 3.0x, which means they need to keep reducing debt.
Right. The current target is just under 3.9x by year end, but the ultimate goal is 3.0x.
So with inflation pressures maybe even slightly increasing, forcing them to work even harder on pricing and productivity just to stand still on margin. How much does that challenge their ability to generate the free cash flow needed to both pay the dividend and consistently chip away at debt to hit that 3.0x leverage target over, say, the next year or two?
Yeah, that's the real financial balancing act to watch. Can they manage the inflation squeeze and still deleverage according to plan? That's the key question going forward.